Hey, what's up guys, this is Dave, and in this video I'm going to speak about a dealing ranges. So you have probably heard about a ICT dealing ranges. In my opinion, it's a little bit overrated because it's just a Fibo divided to the 50%, and this Fib is actually dividing to the two areas, which is a premium prices and the discount prices. And the basic simple logic is that we do not want to be buying in the premium prices and we do not want to be selling in the discount prices. So the logic is actually completely same. Like if we are buying or selling, for example, car, you do not want to sell your car in the discount, right? You want premium prices. And same is going to be when you buying. You also do not want to buy when the prices are in the premium. You want to wait for a discount. So how to define a dealing range? It can be defined as a price swing which has taken the low of the range and the high of the range, and it has a price swing in it, right? So then we place a Fib, and in the midpoint of it we are getting our 50%, which is a equilibrium. In the lower part we have a discounts, in the higher part we have a premium prices. Again, if we are going to buy, we want to wait until the price drops into the discount prices. I'm not saying that the trades in the premium will not work, but more often than not, price will drop down into the premium prices. Next example is an expansion swing, which is basically a big expansion. And again, we do not want to be trapped when the price is making a pullback and then expansion, because this is most likely just a retracement and the price will drop down into this 50% discount. So how we can use these informations? It can help us for the filtering the trades by only trading a buys in the discount and sells in the premiums. It can help us to build a narrative for the potential trade. So as I was speaking right now, if we getting a pullback in the premium prices, our narrative and the reason for next trade could be a sell into the discounts. For setting a target, so I suggest you, when you're setting a target, set it into the 50% of the swing expansion, because mostly around this 50% price can start to do a pullbacks. And of course, for the managing the risk, because obviously you can take a trade in the premium prices, and if you use the stop loss big enough, then you will survive and your trade could be profitable. But if you wait until the price drops into the discount, and that's where you start to take your trade, you will get much better risk-reward ratio, and overall your strategy will be doing much better. When we work with the dealing ranges, we of course have to use a correct time frame alignments. So we're gonna use a higher time frame for the dealing range and the lower time frame for the market profiling, right? Because for example, if we're looking to the daily chart, we want to draw our daily dealing range, and we want to look on the lower time frame, which is in the correct time frame alignment for the daily is 1 hour. We want to be looking at the markets with the lenses of the lower time frame to create a precise entry of our trades. Correct time frame alignments are very crucial. If you don't do this properly, you can make a lot of mistakes. So for example, if you trade on the weekly, your lower time frame will be 4 hours. If you trade on the daily, your lower time frame will be 1 hour. 4 hours, M5, 1 hour, M3 or M1, and if you trade on the M15, you should be executing on the seconds. Combining dealing ranges with the market profiles. So on this example, you can see on this picture, as we have, for example, the bullish order flow, price makes the expansion, and then we measure with the Fibo and we define our premium and the discounts. In this case, as you can see, we have a key level in the premium. This is where the most people are getting trapped. Because why? Imagine you have this key level, people see it, people see the price dropping down, and then we get the reaction on this key level and start to move in the correct direction in the higher time frame order flow, which is all alright and it's actually correct. But knowing this information, that these market makers, algo or whoever the moving the markets, they mostly drop the price to the discount because they want to buy a discount. So what is actually happening in here? By creating this swing low in here and reacting on the key level, but in the premium prices, they creating and engineering the liquidity below it so they can drop it down to the discount. So I suggest you avoid trading the key levels in the premium because as said, mostly it's just engineering of the liquidity and the stop losses below this low where the real market moves starts later. By implementing this strategy into your trading plan, you will avoid being in the trade too early. And instead, by understanding this, you can build your narrative for the potential short trade and target it into the 50% discount prices. So now let's look to the complete picture where we can see how the price has reacted on this key level in the premium prices, and it was just a correction and then price has dropped down to the key level in the discount, and that's where the real move has started. So my suggestion is, if you avoid these trades in the premium and you focus on the longs only in the discounts, you will get, first of all, better risk reward ratio, you will not be in the trades too early, and also you will get better win ratio. So remember, when the price makes an expansion in the direction of the higher time frame or the flow, and then it makes a lower time frame expansion to the key level, the reaction on that is what? Is just a retracement because we are still not in the discount. Then if the price drops lower into the key level in the discount, this is where you get expansion to the key level in the discount, and then is what? Not retracement, but most likely reversal. Reversal on the lower time frame is a trend continuation on the higher time frame. So you need to train your eyes to look at the markets from this angle. Now let's have a look into the example number 3. So again, the price has made the expansion in the higher time frame or the flow direction, and then it starts to do a correction. On the lower time frame, it's going to be expansion. Right? This is where the many people get trapped because they see the price dropping and they think that it's a reversal on the higher time frame, but it's not. Because why? Price is going into the discount on the higher time frame or the flow, and there you can probably get some reaction. If that level is broken, then you can get a reversal, but you don't know it until now. So let's look at this picture again, and you can see that there is no key level at the premium. You can see the key level in the discount. In that case, you will mostly obviously understand that this is not a perpetuum mobile and it's not always happening same, but this is a similarities and the repetitive patterns which we can find out on the market. So when there is no a key level in the premium prices, but there is a key level in the discounts, it's mostly going to be around a 61.8 FIB to the 80% correction. And that's where you're getting on the smaller time frame the expansion to the reversal, right? Not expansion to the retracement as it is on the premium, but straight to the discount, expansion to the reversal on the lower time frame, and again on the higher time frame it is a trend continuation. Now let's have a look to the bearish scenario, which is actually completely the same, but only it's reversed, right? So basically we can see the expansion down and then price is starting to retrace. You can see on the picture it's reacting on the key level, but in the discount, not in the premium, didn't make the pullback up to the 50% to the premium, but reacting in the discount. So what's happening in here? It's actually getting traders trapped into the early short, and they are actually right. They correctly analyzed with the higher time frame or the flow that price will most likely drop lower. However, they are too early in the trade and they creating the liquidity. Because why? Because price then most likely, as you can see on this picture, you can see again how the price comes higher into the 50% premium and then it continues lower, right? So those traders who reacted on the key level in the discount, they've been too early into the trade because price went up into the key level in the premium, and they've been just a liquidity for the continuation and the short adding into the positions by the market makers. And again, same case as for the bullish scenario, when we have a large expansion down and then price start to retracing and we don't have any key level in the discount, then price will most likely go into the premium level, and it's going to be between a 61.8 and 80% of that swing, right? So how can we use this information? We of course are not going to enter early into the shorts, but also if there is not a key level in the discount, we can use it to take a long trade opportunity into the premium prices. And now on this example, we can see the reaction in the premium prices. You can see how the price started to retrace and it has made firstly this drop, right? This is where many people probably has shorted, because if you look into these candles at the specific time, they've been looking very bearish, right? So the traders has entered, and now you can see how the price is going into the 50%, and you can see it's taking multiple highs where those who probably shorted earlier try to hide their stop losses, and now from this 50% level, right, you can see how the continuation of this downtrend continues. And on this example, we can see a reaction in the discount, how the price has been dropping down without any reaction because there was not any key level in the premium, right? So again, we have a large expansion, then price start to drop, which is expansion on the lower time frame, and then we don't have any reaction because there is no any key level in the premium. So price is going straight down into the discount. You can see it has reached this 50%, and then it dropped down into the area between 61.8 and 80, and we are getting a reaction on this 61.8, right? So you can see no key level in the premium, so then we go straight to the discount, right? And we can build the narrative around this and use it for our own advantages and take the trades. Okay, so what's the key takeaways from this video? Definitely always measure the expansion swings and the dealing ranges, because it can help you with the filtering the trades, setting the targets, and building the narratives about where we are currently in the markets. Use the correct time frame alignments for the drawing the dealing range, and then drop down to the lower time frame to build your profile and understand what the market profile is building in there. And you basically looking for the expansion to reversal on the lower time frame, which will be the continuation of the trend on the higher time frame. Trade lower time frame bullish reversal in the discount confirmed by change in order flow, in other words by order block, and trade lower time frame bearish reversal in the premium confirmed by the change in the order flow. Okay guys, so I hope that this video helps you to clarify everything about the dealing ranges. If yes, give me a feedback by giving a like, and now you can add it into your trading plan to filter out the best trading opportunities. So if you like this video, don't forget to subscribe, because soon I will be bringing more videos like this one.